Hello and welcome to another edition of our IndexMore series, where we at Satrix, together with our partners at BlackRock's iShares, provide you insights around investment trends and the macroeconomic forces shaping our world today. My name is Nico Katzke, Head of Portfolio Solutions at Satrix, and I'm delighted to host this session today. We are joined by an esteemed panel of experts to dive into a year characterized by policy mishaps and uncertainty, geopolitical posturing, and a macroeconomic environment that can at the very least be described as fluid. The old Chinese curse, may you live in interesting times, is certainly our lot this year. But how have we arrived at this juncture of constantly questioning experts and established norms on everything from trade negotiations to tariff policy, interest rate regimes, and even geopolitical matters? One may find that the answer to this lies in a fundamental shift in our interpretation of how markets and specifically the economy works. Adam Smith famously argued in his defense of capitalism that we are inherently guided by an invisible hand to work together in a positive sum societal game, where in pursuit of one's own interests, we all benefit through cooperation. The strength of a capitalist free trading system does not lie in the exploitation of some or the bending of rules to favor the few, even though its outcome may at times seem to justify anti-capitalist sentiment. Instead, its demonstrable power relative to any other form of government lies in its positive sum nature. Technological innovation and its harnessing to the good of many makes societies boundlessly more productive and prosperous. Free trade allows specialization, and through unguided pursuit of one's own interest, we all contribute to the betterment of society's living standards as a whole. Now, causes of unequal outcomes should be addressed directly, without undermining the benefit of a liberal pursuit of one's own fortune. Yet, despite the advances in our understanding of how free markets work and the benefits thereof, both the far left and far right thinkers tend to disagree with free market virtues. Both groups tend to see the world, for most part, as a zero-sum enterprise, a game that is either won or lost. If China succeeds, the US loses. If migrants prosper, it comes at the expense of native-born individuals. Trade imbalances reflect a winner and a loser. Both cannot enjoy mutual benefit. Imports replace jobs locally. On the left, it seems logical that individual success comes only through exploiting others. Now, the fixes to these problems to those on the left or on the right are not a deeper pursuit of free market enterprise, but rather policy restrictions that aim to turn negative sums into pluses at the cost of those on the other side. Now, such policies regress into an isolationist us versus them, which over longer term benefits neither us nor them. Now, such policies stemming from either of the political extremes that I mentioned have invariably in the past led to negative sum outcomes. Now, this seems to be a lesson that we need to relearn once again to fully appreciate the benefit of free enterprise and healthy competition. Now, so far this year, the Trump administration has confidently embarked on a dangerous game of rhetorical improvisation when it comes to setting trade policy and discussing delicate geopolitical matters, virtually all with little to no clear win so far. Unprecedented policies have been set and reversed without much clarity or guidance, with proponents somehow arguing that a complicated fourth-dimensional chess game is being played that is only clear in hindsight. Now, while markets were initially shook by tariff policy decisions taken in Q1, the strong rebound since April reminds us that one writes off the US equity market at one's own peril. While Trump's deal-making capability and negotiating leverage may not be as decidedly powerful as his ardent supporters might believe, the current US administration makes policy decisions very much with the market in mind. Now, while the Fed has failed to bow to political pressure, at least up to now, the US government still has considerable fiscal and regulatory stimuli that it can fall back on, especially considering the obedience of both houses of Congress to the Trump administration's wishes. You can be sure that this administration will do whatever it can to buoy up equity markets by providing required stimulus to get runs on the board, without much regard for the longer-term impact of such measures. In fact, one might argue that getting a W for Trump arguably matters more than the ultimate viability of most decisions made by this administration. Now, the question then remains how investors should navigate the remainder of this year with so much uncertainty abounding. I'd like to now invite our panelists to share their thoughts and weigh in on the world as it stands. Now, joining us today is someone, firstly, that's very familiar to our viewers. It is Kareem Shadid, head of the EMEA investment strategy at BlackRock. Hello, Kareem. It's great to have you back. Then we also have an IndexMore debutant today in the form of Jamie Forbes, who is a senior product strategist at BlackRock. Hello, Jamie. It's great to have you on. And then finally, we also have the ever popular and irrepressible Kingsley Williams, CIO at Satrix, who will share insights into how all this uncertainty that I was mentioning now, and that's abounding, is impacting local flows and index returns for our markets. Now, before we get to our panelists, I'd like to invite you to share your views on how the topsy-turvy tariff policies are affecting your investment outlook. You should see the choices appear on your screen very shortly. And if you see it appearing, you can just make your choice. It's either A, B, or C. And the question is, what best describes your view on US trade policy and its impact on your investment portfolio heading into H2 2025? Is it generally positive? Is it generally negative? Or are you more neutral and you believe that US trade negotiations, either way that it plays out for the remainder of the year, will not materially impact your own investment portfolio? We'll give you 1 minute to make your choices. While you are reading and making your choices, let me just remind you that you can use the Q&A button at the bottom of your screen at any time during this webinar, and I will keep an eye on the Q&A, and if anything interesting comes up while we are discussing, I might just throw that to the panelists. Otherwise, we'll leave a few minutes at the end to get to your questions. So please, by all means, ask questions using the button at the bottom of your screen. See, we are nearing 50% of the responses so far. Okay, I'm going to give it 10 more seconds. Okay, with that, I'm going to go to the results. So interestingly, you should see the results coming up on your screen. About a quarter of you are saying you are feeling generally positive. US-led trade negotiations will ultimately be beneficial to global trade without causing long-term inflation disruptions. About half of you are saying generally negative. US trade negotiations will likely weaken economic conditions for both the US and its trading partners. Again, back to the negative sum world that I mentioned in the introduction. And then about a quarter of you are saying you are neutral. So about a fair spread between neutral and positive compared to half of you saying you are more negative in terms of trade policies and how it's going to impact your investment portfolio. Kareem, if I can ask you to maybe unmute and put your camera on and say hi to our audience. It's great to have you back, Kareem. Kareem Shadid. There you go.
Great to be Kareem,
back. Yeah, great to have you. Heading into 2025, we always knew markets were going to be volatile. And even conservative economic assessments made after caveating the unpredictable and fluid nature of policy and regulation under Trump's regime. Can you give us your assessment of the year that's been so far from your perspective from BlackRock, which spans a global portfolio, I suppose, and a lot of different indices and funds that you manage? What's your feel of the market been so far this year?
Yeah, as you say, it's been a very interesting year, a year of significant policy uncertainty. So the way that we measure policy uncertainty is through this index, an in-house index that we have created that looks at all the big data, the alternative news, and other forms of data to really get a sense of how much policy uncertainty has increased. And what's striking to me is that our measure of policy uncertainty today puts it at higher than during COVID, which shows that whilst both periods were somewhat of man-made uncertainty around, shutting down economies in the case of COVID to try and stop the spread of the disease, versus today introducing barriers that are man-made for specific policy objectives that the US administration has been very clear about. These are objectives around rebalancing the goods trade balance between the US and the rest of the world. So similarities there in terms of the man-made barriers to trade, but creating a very uncertain backdrop for policy. So when I look at markets in this context, we are seeing significant questions being asked around, can US equities continue to hold their leadership versus other equity markets like they have in previous years? Assuming also that the risk-on environment for equities continues. And do we continue to own equities? Can US equities continue to demonstrate their leadership? Because as you'll know, Nico, this year, the leadership has looked different. Europe has been outperforming, actually, the US. So a bit of a change there, and a question on which one will be more enduring. And then secondly, what do bonds do in my portfolio? Because in an environment like today, between 2020 and 2025, the correlation between global equities and the global aggregate bond index, is at 0.5. Whereas in the period between 2015 and 2019, so pre-COVID, that correlation was negative. So we're now in a positive correlation environment for the two. So what does this mean for my bonds? If they are going to fall at the same time that stocks fall, then what do I do with that sleeve? I focus on income, but I need to look at other diversification sleeves in my multi-asset portfolio that look like things like gold or hedge funds, especially market-neutral hedge funds. So to sum up, this year has been interesting because it has shown us a lot of examples of how markets behave in an environment of protracted policy uncertainty, especially around trade barriers. And it's an environment where we have to rethink equity regional leadership. We are still positive on equities. We want to stay invested. We like US equities because of earnings. We think corporate America is still very strong in terms of the earnings that it's delivering as per the season that's just wrapping up. And then thinking about bonds for income, not diversification, and thinking of diversifiers like gold and hedge funds.
And so have you recalibrated your asset class positioning and investment outlook based specifically on what you've learned this year so far about US trade negotiating efforts and policy setting, the uncertainty that abounds? I mean, have you recalibrated your positioning and your outlook?
So the approach that we're using to navigate this is really to stick to the fundamentals. So rather than trying to recalibrate on every trade headline, because things are changing quite quickly. As you know, we had the Liberation Day announcement. Then we had the pause on reciprocal tariffs for 90 days. Then we had the pause on US-China tariffs and the bringing down of those tariffs from the highs, and the pause for another 90 days for those tariffs. So a lot has changed, and obviously the mood has gone from risk off for the first half of April to something a bit more risk on in more recent weeks, which, by the way, Nico, sidebar, goes to show that it's always about the time in the market, not timing the market. Because if you try to time the market with the market bottom in April, the sell-off there, if you took chips off the table and you tried to put them back on, you probably missed it. And there is a great example on why it's always about the time in the market and staying invested. And so to answer your question, we are staying invested in equities. We are overweight equities. And within that, we are staying invested in US equities. The recalibration is happening more at the level of we perhaps position for an environment where the gap in returns between the US and the rest of the world is going to be smaller. It's going to be a smaller gap going forward, which means that we see selective opportunities to close that gap in Europe, especially in sectors like European banks and European defense. We like those sectors a lot. And then on the US level, we're really thinking about the leadership of the Mag 7 or the top mega caps and see that there is a bit more breadth today in the earnings picture. So we're looking at exposures like the S&P equal weight in order to position for a bit more of that breadth.
Interesting. Now, many investors that we speak to have, since the most recent US equity market bounce back, argue that it is an opportune time to take the off-ramp in terms of their large US exposures in most global indices, MSCI World, MSCI ACWI. I mean, either way you cut it, you have a very large, call it 60, 70% exposure to the US. Now, others have argued that even at historically elevated valuations, the US will likely emerge strongest from any trade reset that we might see in coming months. Now, are you looking for the off-ramp, looking to accelerate, or are you keeping things in neutral when it comes to U.S. equity exposure specifically? So you were talking about equities generally, but specifically U.S. equity exposure.
Certainly not looking at the off-ramp. I mean, as you said, U.S. equities are 60% of MSCI ACWI and 70% of MSCI World. This is not going to change overnight. These exposures will likely remain the largest exposure in benchmarks for time to come. And instead, what we're looking at is focusing on an up in quality approach. My colleague Jamie can speak quite closely later on. She's much closer to the factors and systematic investing side of things here at BlackRock. But we like to keep an up in quality approach. Perhaps to manage some of the risk drawdown, we like to focus on exposures like minimum volatility, also in the factors lens, to help manage some of that risk drawdown in equities. But we're certainly not taking equity risk off the book because of the risk that I just mentioned, Nico, around missing those rallies when they come. We want to stay fully invested, and including in US equities, and instead focus on those tilts towards up in quality, minimum volatility, also looking at exposures within sectors such as US industrials that benefit from higher government spending, and also US financials that benefit from potential deregulation bills in the US.
So thank you, Kareem. Jamie, Kareem said he would like to pass you the ball. So if I can maybe get you on. Now, Jamie, we can debate endlessly on whether we are optimistic or defensive or neutral on global equities, or see value in higher yields, or like the shine of gold, or whatever it may be. But what are you seeing in terms of flows so far this year? In other words, what are investors doing when it comes to putting their money where their proverbial mouths are?
Yeah, thanks, Nico. And thank you so much for having me on today. Indeed, in terms of the what we're seeing in terms of flows, it very much mimics a lot of what you and Kareem set out as the backdrop of the heightened market volatility and policy uncertainty, really leading to this year significant rotation into much more defensive positionings. So the three headline themes I would highlight are in equities, dividend and income, as well as gold, and low volatility equities. And then the underlying currents of those being investors looking for greater selectivity in the US, so along the lines of what Kareem spoke about, I can get into, as well as a resurgence in European equities, but generally seeking diversification. And if I could maybe just provide a bit of color behind those three headline themes of dividend income, we saw in the first 4 months of the year for EMEA-listed ETPs, over $3.7 billion of assets coming into those types of strategies. And just to put that in context, that is just shy of the last 2 full years put together. Where investors are looking for quality dividends or for dividends is they're looking for a bit of a quality bias to that, to Kareem's point about the earnings stability. And they're investing in Europe, global, and to some extent US. But interestingly, also seeing an uptick in derivative income strategies, which arguably are a bit more active in nature. And then secondly, for gold, April was globally the 5th consecutive month of inflows in gold, with over 10 billion added. And then for EMEA listed products, January was the best month for gold ETP flows since Russia invaded Ukraine in March of 2022. And we can come back to more of that later. But just to round out low volatility strategies, so those are targeting the lower beta stocks, lower correlation to the broader market. That's where we saw over 2 billion in flows in EMEA, setting a new record for monthly flows in low volatility strategies, and marked the 4th consecutive month of positive flows. And investors are strongest in investing in min-vol in world and Europe, but also in the US. That is where they are net positive, as investors we're seeing taking that more cautious approach in buying U.S. equities. But maybe
That's
interestingly, as I was just going to say, as MSCI emerging markets is up by 10% year to date. Not surprisingly, we're not seeing flows into EM low vol, as that is a more risk on part of the market.
Right. It's interesting you mentioned low vol. It's something we've done a lot of research on. I know, your team has also looked at it, and it's an interesting investment theme because, on one side, if you're not willing to take risk, then you shouldn't be rewarded, or, the sort of adage in finance. But still, there are times where low vol strategy can actually benefit your portfolio tremendously, especially in a highly uncertain environment. But we can speak about that as well. But I'd like to get a sense from you. The last time we spoke to yourselves, we spoke about flow trends pre the US election outcome. And BlackRock highlighted that a large proportion of assets were sitting in cash-like instruments, likely waiting to be deployed more productively once more certainty has been established around policies, etc. Now, have investors since the pre-election, since we last spoke to you, gained greater certainty to allow more deployment to growth assets based on flow numbers, or is cash still attractive for developed market investors?
No, good question. I mean, I think some of the numbers that I just quoted, certainly investors are putting money to work. I think a couple of key themes that we're seeing is that undercurrent of diversification. And I would say we're really seeing that play out both in regional and style factor selectivity. So within regions, if we think about developed markets, we are definitely seeing investors put their money to work in anything not the US. So US equities has stepped down relative to the monthly average, but we are continuing to see where they are putting that money to work is investors shunning that concentration risk. So Kareem alluded to moving away from the concentrated Mag 7, and we're seeing flows into more equal weight or capped approaches in US equities. Also, the other pocket of risk on that we saw is emerging markets has really been a lead of where investors are putting their money to work in this first quarter. India, for example, saw its largest inflow since June of last year. And then that's been followed by broad developed markets and European equities. We really saw in February and March a record-breaking months of European equities, over 10 billion in Q1. And that has slowed slightly in April as some U.S. investors have sold European equities, but EMEA investors remain net buying of European equities. And within European equities, we're seeing DAX be a key area of allocation. So I am in Germany today, and I think the DAX just hit its record high yesterday. We're seeing industrials into cyclical sectors, mid caps, and again, kind of the quality and dividend part of the market. And where investors are buying US, whether it's a diversification play or more quality or defensive tilt. But to your point about maybe that second theme of factors, one thing that I think has been really interesting about this year to date in terms of the market environment is we historically have seen investors moving between factors, i.e. sell out of a risk on momentum factor, for example, to fund maybe more defensive allocations. But this time is different. We actually have seen through April positive flows across all factor exposures, but that story is more nuanced when you double click into the regions where investors are expressing those views. So for example, although I mentioned those headlines are in favor of more defensive, low vol income generating exposures, value and momentum that tend to be more risk on trades, they've still been strong. So what we're seeing though is that for value, for example, they're buying Europe value, but selling US value. Momentum, those flows are primarily going into Europe. And maybe touching on a theme that Karim mentioned, that momentum factor is overweight financials and industrials, where we have also seen investors play that from a sector level. And then the other bright spot within European exposure has been multi-factor, where that's maybe bringing those two themes together of factor and regional diversification. Maybe just touching on the very last question that you asked around whether cash is still attractive. So yes, investors are putting their money to work in those different ways I outlined. But interestingly, our active cash team, so they launched an active ETF in Q4 last year. That's actually been one of the fastest growing active ETFs in the top 10 of EMEA active ETFs flows year to date, and currently one of our largest active ETFs with over 600 million. So all that to say, money is definitely still in motion.
Amazing. Now, aside from asset class flows, are you seeing flows into or out of indexation in the US and Europe more broadly? Specifically, are asset flows moving around within index offerings, or are investors looking to active managers to navigate this market volatility? You know, we've seen statistics that last year indexation has overtaken active management, but are you seeing a flow back to active managers, kind of investors wanting someone with a hand on the wheel, or are they happy to follow rules-based investment strategies?
Yeah, great question. So the answer is a little bit of both and. So we continue to see incredibly strong ETF AUM growth. Really, we see, for example, in Europe, ETFs in just the past 5 years, assets have doubled from 1 trillion to 2 trillion. And that is really a reflection of the growth of more precise indices that allow investors to express their asset allocation views with much more granularity within index, relative to thinking generally index versus active. So certainly we continue to see growth of ETF AUM, but that's largely driven by much more granular exposures within indexing. But then the other key theme that we are seeing in this year in particular is with the advent of the ETF serving as a wrapper and now some actively managed strategies being accessed through that wrapper. One of the main things that we're seeing as a growth area is active core enhanced building blocks that offer a little bit of enhanced alpha at the core of portfolios, being seen as a partial replacement for core index. So not a all together switch, but a both and where, given where current market environments are and the different factors that might be expected to be rewarded in regimes, being able to actively rotate around those factors. So currently, for example, we're positioned with that leaning into low volatility. As you said, you don't typically get rewarded for taking lower risk, but if you are protecting more on the downside than you're giving up on the upside, then that can lead to stronger returns over time. So those are two, I think, of the most interesting areas of growth for ETF investors we're seeing.
Yeah, that's fascinating. Thank you, Jamie. I'm gonna bring back Karim quickly. Karim, I want us to talk commodities. You know, while gold has done remarkably well over 12 months, broader commodity indices have actually not done as well. You know, thinking, for example, oil and several other key base metals have actually declined in value following the imposition of tariffs earlier this year. Now, are commodities broadly an asset class that you look to for diversification or an inflation hedge, or is it mostly a tactical play from your perspective?
Nico, it really depends, because I would, to your point, break up commodities into a couple of segments. The precious metals, so that's gold and friends, gold, silver, and this type of exposure. And then I look at industrial metals, and that's more focused on the copper and the metals that depend on China demand, depend on view on global business cycle. And then the third bucket is oil, energy. And so when I look at those three segments, for us, gold is still very, very opportune as a sleeve in portfolios, as a diversifier versus stocks and bonds. So yes, to answer your question on commodities, it is specifically gold and precious metals that we think about as portfolio diversifiers. Why? Because the 10-year correlation between gold and stocks is at sub 0.2. So it's doing exactly what it says on the tin in terms of diversifying versus stocks. And if you go back to that statistic I shared earlier about the global ag and equities having a correlation of 0.5, that is the reason why you want gold in a portfolio, to diversify against that high stat. As for the industrial metals, I think there is a mixed bag here, because yes, China stimulus has come through across monetary especially. However, it is not enough to trigger a huge upcycle in Chinese demand that would be a big tailwind for the industrial metals. So we're still a mixed bag there. And the global cycle economically is not very strong right now. And then similarly on energy, it's been a supply-driven market. We do expect the supply to remain quite ample. Absent a big geopolitical shock, we expect the oil price to go sideways or a bit lower. And so that's how I would break it up.
Danny, if I can maybe ask you to just elaborate on, are you seeing any interesting developments in commodity flows specifically? So considering what Karim said, there's a lot of nuance, but across the board, are you seeing commodity take up from investors?
Yeah, it is a mixed bag indeed. So if I start with gold, flows into gold passed a 5 billion peak in mid-April. We're now seeing a bit of profit taking on the margin, really on the back of the strong performance of gold. Outperformed MSCI World and S&P by 19% over the last year. So to Karim's point, as a diversifier and seeing a bit of profit taking now. The cumulative flow year to date, so as of last week, after that profit taking has still been over 2 billion into gold. Now, contrast that with other commodities. Silver, for example, has seen about 800 million inflows year to date, which is significant for silver given the size of AUM, but say not to the same extent as gold. And maybe just to finish on gold, we are also seeing stronger interest in currency hedged gold, just given currency volatility and dollar weakening. So certainly a role playing in the portfolio there. But across broad commodities, so in some of those and friends that Karim mentioned, we actually have seen the largest outflows in copper and oil and gas commodities. In copper has seen outflows year to date of 650 million and oil and gas of 400. So it's very much a different picture depending on which commodity. So arguably investors seeking a safe haven in gold and silver.
Yeah, it's a fair point. I think, Karim, if I can ask you to jump back on, we haven't spoken about fixed income in any great detail yet. I mean, you did mention your first answer. You did allude to it, but it's been such a key theme, underlying theme for most investors. Is, how are central banks going to react to kind of inflationary pressures? Now, most developed markets, central banks have softened their monetary tone in recent quarters, and rates have come down somewhat. But the Fed has remained cautious. The Fed chair has faced unprecedented pressure to cut rates, yet he remains defiant that inflationary pressures do remain, considering all the tariff possibility of tariff hikes and the like. What is your reading of this situation looking forward, and where on the term spectrum do you see the best value currently?
I think that the scenario that you laid out for the Fed is one that I thoroughly agree with. It's this idea that even though growth has started to show some signs of softening, and here, of course, there is a disconnect in the growth picture in the US between the soft economic data and the hard economic data, whereby the soft has weakened, but the hard has remained strong. Against this backdrop, the Fed cannot rush to cut rates because inflation is quite sticky, and we expect inflation to remain sticky because of the tighter approach to labor labor market in the US. For example, the number of newcomers into the US, whether at the border or through deportations, is shrinking. So that's tightening the labor supply picture for the United States, which is inflationary. And the second inflationary component is around tariffs. Trade friction, supply chain fragmentation does trigger inflation. And so with this inflation picture in mind, we think the Fed can only cut rates 1 or 2 more times this year. So we have held a view to be cautious on the front end of the US Treasury curve. Now, the market has caught up with our view because the market pricing for the Fed, which at one point last month was 4 cuts for the rest of this year, has now caught up to us with 2 cuts priced for the rest of this year. So we see the market pricing as more fair now and are comfortable to own the front end of US Treasury curve as a result. We also like the belly, but we stay away from the back end because we think that the term premium, which is the amount of price that investors demand to own the longer end, is going to continue to go up, meaning investors will demand a lower price for longer-term bonds, all else equal. So we expect this yield curve steepening trend to continue in US Treasuries.
So the questions are actually coming in thick and fast today. And Karim, if I can keep you on just to answer some of our attendees' questions, and Jamie, I'll rope you back in as well. So just before we get to Kingsley, I just want to tackle some of these questions. I think it's really interesting. So one question is about, and I'll pose a few to you, Karim. So if you don't mind, and you can kind of decide how you want to navigate answering them. One of the questions, and there's actually 2 that are quite similar in this regard. It's basically saying that, alluding to the fact that Trump is, kind of playing a long game when it comes to setting tariffs and positioning or changing U.S. fiscal policy. But would his successor need to kind of follow in his footsteps? And how do you see the longevity of some of these trade resets, if you like? Are you seeing it as kind of a temporal shakeup of the current status quo that might return back to normal, or are you viewing it in BlackRock as a long-term reset from an asset allocation perspective? That's the first one.
Yes.
Another question that's kind of related to this is, has the U.S. through setting these aggressive trade policies has it affected their stance from a global trade perspective? And what's your view on that? Is the sense that you're getting that investors are kind of viewing the U.S. as, less of a partner, I suppose, again, through the long term? Like, has the U.S. kind of shot an own goal through being overly aggressive, or do you sort of buy into this 4th dimensional chess game that's being played, and everything will be clear in months to come, and everything will kind of return back to an even better outcome in future? Or do you see this as a kind of, I'm not sure if I'm making sense, but is this do you take a pessimistic stance or a more optimistic stance when it comes to the current trade negotiations we see?
It makes a lot of sense. And I think that this is really a question, both questions are alluding to one thing, which is that supply chains have been getting more fragmented over the past years and are likely to continue to get more fragmented. So I need to take a step back, zoom out, and acknowledge that what's happened this year with US administration and trade barriers is not new. If you look at the relationship between the US and Mexico and China, for instance, even on this forum before, talking to you, Nico, we have spoken about this last year. It's this idea that, and the year before even, it's this idea that US and Mexico have become the largest trading partner, displacing China. So Mexico has displaced China as the US's largest trading partner in 2023. So this is before the trade barriers announced now. And what has driven this is the friend-shoring theme, this theme that countries prefer local supply chain partners over further afield supply chain partners to control the cost, to control the supply chain. And so this rewiring of supply chains predates the trade barriers this year. Now, the trade barriers this year introduced by the US administration, of course, accelerate the theme, but the theme in itself is not new. And so as we think about this theme, we have been talking about supply chain fragmentation as one of our 5 mega forces that are driving structural transformation in the global economy and in global markets and are long-term drivers of asset class returns. We have been talking about this for 6 years, and we will continue to talk about it for another 6 years because it will continue in that direction. So I hope that answers your question about the broad direction of trade and whether this is a one-off. No, it's not a one-off. This is part of a long-term direction. Now, in terms of the more near-term, we see the U.S. trade policy more near-term reaching a landing effective tariff rate from the viewpoint of the U.S. somewhere between 10 and 15%. So after the pauses, this is roughly where we are now. After the pauses, we expect the 10%, even though the reciprocal tariffs have been posed, we don't expect after the 90 days lapse to go back to zero. We expect the 10% to be the minimum level for all countries, which is the level that the UK achieved with the US in their trade agreement 2 weeks ago. And if the UK was not able to repeal the 10%, it's unlikely that other countries will be able to do that because the UK is one of the US's closest allies and has a trade balance with the US that is pretty balanced. It's not too much in deficit, it's not too much in surplus. So we expect the 10% to be the baseline, and we expect 25%, which is roughly, the China tariffs that have remained now are around, 30%. We expect 25% to be roughly the ceiling. And so that ceiling, that 10 to 25 sort of floor and ceiling is where we think things will head, landing us in an effective tariff rate of around somewhere between 10 and 50%.
Really interesting. I also want to get just a very short answer. How did you answer the poll? And you have to be honest.
Remind me the options.
So are you positive, negative, or neutral based on your own personal investment forecast for the remainder of the year?
Positive, and I'm honest because I stay invested. That is, I told you to stay invested earlier, and I put my money where my mouth is.
So that's going to lead me, and I was hoping you're going to say that because that's going to lead me into a question that one of our viewers have asked. So Roy asks, and I'll summarize it, but it's a very interesting question. So he says most professional people in the investment world keep punting time in the market versus timing the market. You just did it again. And I agree with that sentiment, but he says, yeah. And so he says, if this is the case and they follow their own advice, how come there are such swings in the equity markets? This is surely not as a result of individual investors trying to time the market and making emotional decisions. It is surely only the big players managing big funds like yourselves that cause these, gyrations in the market. How would you respond to that?
It's a great question, and this is why we analyze positioning really, really closely. I would break it up into 3 components. You have the institutional money, so to the point asked, the large institutions. We have the retail investor, that is a mover, especially in US equities. I would answer the gentleman who asked this question, that actually the retail investor can be a dial mover in US equities because retail participation in the US stock market is actually quite high. And the third component is the hedge funds, especially leveraged hedge funds. Each of these 3 components can be movers for markets in the near term. What we've seen since the Liberation Day announcement and then the pauses announcement is that the institutional asset class, the institutional investor, has largely remained on the sidelines. So they actually have not tried to time it too tactically. They have actually remained invested. They did not capitulate on US equities when we had risk off, but they also haven't been rushing back in. They've remained on the sidelines. The retail investor has been a big buyer of the dip. So we've seen significant retail participation in the market since the mid-April rally. And hedge funds have delevered during the risk off and have not relevered since. So these are all the insights I would share there.
That's awesome. Thanks, Kareem. Jamie, if I can bring you back just briefly, there's a few questions in terms of flows that we didn't get to in our discussion, but that our viewers are asking. The first one is, are there any notable changes in flows to or from China specifically? So how has China flows actually been impacted by all the trade negotiations that are yet to take place, I suppose? And there's been a lot of posturing from both the US and China in this trade war. So how has this affected flows? I suppose that would be equity flows to China. And then also, a viewer is asking, you mentioned flows to India, but has this reversed somewhat subsequent to the conflict with Pakistan?
Well, I'll take the first question first in terms of China. The answer is that flows have significantly increased. If we look at, again, the ability for investors to get more precise in their exposures, there are a number of single country ETFs in the market, and by far of single country emerging market products in the market, China has led most of the flows year to date. So over 2 billion of assets net inflows into China. Interestingly, one of the ways that we've seen investors play that China theme, as it were, is particularly in tech stocks in China being seen as the area of greatest opportunity, maybe if they want to get selective in that market. So we've seen over 600 million into China tech. So interestingly, investors definitely seeing China as a beneficiary in the long term to be positioning their portfolios for. From the India perspective, I guess my comments were very much sort of on a year-to-date basis, and we haven't really seen any strong theme in terms of flows one way or the other coming in. That being said, there is something unique in the Indian equity markets where any sell-offs of Indian equities would trigger a capital gains tax that is not necessarily in investors' favor. So all that to say is that's a friction in that market that would not necessarily be a consideration relative to geopolitical considerations.
That's fascinating. So in other words, flows into India is more sticky than to other regions, I suppose. Would that be a fair assessment?
For that reason, yes, exactly.
Yeah. Thank you, Jamie. Thank you, Jamie and Kareem. Fascinating insights. I'm going to ask Kingsley to join us on the proverbial stage, specifically to give us a bit of a local perspective for those of you dialed in from South Africa. Kingsley, before we do that, there is a question around economic themes this year has resulted in market volatility globally. Would it be prudent to recommend index inclusion as part of your portfolio mix, considering they are tracker funds? And so I suppose the question is asking the question from the perspective, can index vehicles actually be considered as prudent when there's a lot of volatility in the market? I would posit that if you consider what the speakers have been saying up to now, especially Kareem at the start of the webinar, mentioned the fact that there's a lot of different type of index investment vehicles, and we're past the point where we think of index strategies as being passive, a sort of homogenous group of investment vehicles. We always at Satrix rather frame it as being index investment vehicles, where you have different types of strategies. Jamie mentioned flows into low-vol strategies, for example, flows into factor strategies like momentum or multi-factor strategies. And so by blending different indices, you can actually arrive at quite a robust portfolio construction. So I would just caveat it from that perspective that The question is asking it from the point, I suppose, that index tracking is kind of homogenous. It's the same type of investment vehicle, which we know is not the case. Kingsley, you can sort of add your thoughts to that, but I also want to ask you a question. Just in terms of what we've heard about global flows and how our speakers have spoken about their views on asset class positioning. So in addition to the first question around index tracking vehicles, can you also give us a sense of the industry flows we are seeing in South Africa year to date and over the past 12 months, considering all the volatility that we've spoken about?
Sure. Thanks, Nico. Thanks for the questions. Let me tackle your first one. I think there is often this common belief that tracking an index is a more risky proposition than what you may get elsewhere. And it's important to remember that an index is ultimately representative of, to the extent that it represents an asset class, to the extent that it's a broad representation of that asset class, it is representative of, what the performance of that segment of the market is doing in totality. And in the same way that you would have some strategies outperforming the index because they're in favor and others underperforming and the index sort of kind of being somewhere in the median. Similarly, you would expect some equity strategies, if we're talking about equities, to be more risky than what the index is offering, in terms of being more concentrated, more exposed to more volatile stocks because that's the nature of the strategy. And similarly, there would be other strategies that would be less volatile and, because they're specifically aiming to protect capital or minimize volatility or risk on the downside and drawdowns. So I think it's a spectrum, but what remains a timeless truth is that, to the extent that the index is broadly diversified and representative of the asset class, you're going to have a distribution of spectra or returns around that. And you can't really say whether the index is going to be more or less risky than what any other available investment strategy might be around that. So I think that just complements a little bit of what you're saying. And that's just talking about a vanilla broad market index. Obviously, there's lots of variations to your earlier point of some being, you can tailor an index to achieve any particular objective, targeting low vol, targeting quality stocks, targeting defensive type stocks or a subset of the market that offers protection. So it's really about what you want in the portfolio. And the other thing that remains a timeless truth is that by following an index-based approach is you get a very, you get a lot more certainty around what you're going to get because it's very rules-based and objective. And obviously the other timeless truth that generally goes hand in hand with an indexed approach is that you get the benefit of that lower cost way of gaining that exposure, which obviously over the longer term compounds in your favor. So I hope that addresses the question. I think at the end of the day, though, we very much adopt the view that there's no such thing as passive investing. You've got to construct your portfolio holistically, decide what your asset class exposure is, decide how much exposure you're going to have to risky assets versus defensive assets, how much is going to be offshore, how much is going to be local. There are numerous active decisions that need to be made, even if you then choose to follow an index tracking approach within each of those asset classes. It doesn't take away the active decision making when it comes to investing. So hopefully that addresses that question. But to come back to your question on flows that we've seen year to date, I'll speak a little bit about what we're seeing across our book. And given that our book is quite broad in terms of what we offer, I think it does provide a reasonable lens or proxy into what's happening within our market more broadly. So in terms of where we've seen the strongest flows year to date, these are some of the strategies which are available in various different vehicles in our market. MSCI World is a perennial favorite amongst South African clients. So we've seen the largest flows go into that type of strategy across different vehicles. S&P 500 remains strong. People investing through our Satrix Balanced Index Fund, which offers high equity exposure across local and offshore markets, broadly diversified, Reg 28 type strategy. people investing in local equities through the top 40, tracking the FTSE JSE top 40 index. NASDAQ 100 has also attracted good flows. And then also our FTSE JSE capped all share strategy, which we've got available in ETF form, has also done very well. So quite a broad spectrum of predominantly global as well as local equity strategies, as well as broad multi-asset strategies that are attracting large flows. But I mean, these are some of our flagship funds and some of our largest capabilities. So perhaps it's unsurprising that this is where we're seeing the largest flows. That being said, though, I think it's encouraging that our clients and investors have continued to stick to their investment strategies. So because those are some of our flagship strategies, and we're continuing to see large flows into these funds, that for me tells me that, you know, clients are continuing to invest on a regular basis through these well-adopted strategies, you know, to manage their investments and grow their wealth. And so they're not reacting to short-term volatility and uncertainty. Very much echoing Kareem's advice earlier in terms of, you know, staying invested, not looking to switch, which, you know, inevitably is quite difficult to do and can often be done at the wrong time. I mean, this essentially speaks to clients adopting a rand cost averaging approach to growing their wealth, which makes a lot of sense. You know, this regular, disciplined approach to investing steers clear of trying to time the markets, which, again, you know, is always easy in hindsight to say, oh, I should have done that. But it's very difficult to consistently get right on a forward-looking basis. You know, whether the market appears to be high or low or overvalued or undervalued, it's never clear at that point whether it's going to appreciate or decline further from that point. So this is where term is also so important when making investment decisions and ensuring that, you know, this is matched to an appropriate asset class and the risk associated with that asset class. If I zoom out a little bit longer and just look over the last 12 months, over the last year, we're certainly seeing flows into our business do very well across our unit trusts and ETFs, and, you know, relative to our competitors in the market that are operating in that same space. I mean, we've been attracting 4 to 5 times the quantum of flows in excess of our next largest competitors. So I think a big thank you to all of our clients, particularly those on this call, for their support over the last 12 months and for your you know, discipline to continue regularly investing with us. We greatly appreciate that. I think one other thing to maybe just quickly touch on, Nico, is that investors on platforms are also enjoying the increased flexibility and range of choice offered by Satrix ETFs. And investors, just as a reminder, can, you know, now have the freedom to access their preferred unit trust and ETF seamlessly on list platforms. So this is where an advisor can still guide and manage a client's portfolios, but now have a much wider range of investment strategies available to them because ETFs are available on those platforms too.
Amazing. Thank you, Kingsley. I see we are fast running out of time. I just want you to maybe quickly share with us, Kingsley, as part of the Satrix Balanced Index Fund SAA review that we did last year, you highlighted a few key decisions made regarding global fixed income, real asset exposure, and EM specifically. Can you just briefly bring us up to date with the positioning and whether these changes have made a positive contribution overall?
Sure. I'll try to run through it quickly. You know, just to round off some of the earlier comments, markets are obviously moving very quickly, with the state of play being highly dynamic. But to the end of April, we have seen emerging markets outperforming developed markets by in excess of 5% in dollar terms. And we do have an overweight allocation relative to the emerging market weight within the MSCI All Country World Index. So that's been a good benefit to our clients in our balanced fund, for example, where we have that overweight exposure. We also have a more defensive equity exposure to listed infrastructure, which has outperformed by an even bigger margin of 7.2%. I'm not going to go too much into the merits of listed infrastructure. It's safe to say that it's a more defensive equity allocation within our portfolios, which offers higher yields and lower drawdowns than what you typically find on a broad market index like MSCI World. So we like it. It works well within a multi-asset portfolio, and it helps diversify the equity allocation, particularly on the global side, away from those mega cap stocks without necessarily compromising the return profile. So lower volatility, lower correlations, but similar returns. So we really like that allocation in the portfolio. Just further to emerging markets, where I mentioned we have an overweight allocation, we've also seen South African equities do really well on a year-to-date basis, outperforming developed markets by 12.6% in Rand terms. So if we convert both into Rands, local equities have outperformed by 12.6% relative to developed markets. Part of that is our strengthening currency off the back of dollar weakness. But the big driver has really been our resource stocks. So, we've obviously seen very strong performance in the gold price, and that would have had a leveraged effect on our gold mining companies, which are leveraged to that price. So that's been a big driver of those returns. I mean, the resource stocks have outperformed our market by 27% year to date. So massive performance, and obviously that's a big component of our local equity exposure. So look, I think that's the main thing. The other drivers that are favorable for our equity market is its lower valuation rate, PE ratio of around 13 times, in contrast to developed markets, which is in excess of 21 times. So that provides an underpin. And we've actually seen, can you believe it, that the 5-year return of local equities, all in Rands versus offshore equities, is actually higher over the last 5 years. Local equities has exceeded the 5-year return of developed markets. So that's the first time that's happened in a long time. It's always been one-way traffic with the US and developed markets outperforming our local markets since the global financial crisis. So that's an interesting development. I wouldn't go as far as saying that's a new trend and that people should adjust their portfolios off the back of that. I think there's still a lot of things that our local economy is grappling with. How do we stimulate economic growth? How do we bring the fiscal budget in line, balancing that? That's happening today. How do we rein in growing debt to GDP? And obviously very topical is what transpires later today with the meeting between Presidents Ramaphosa and Trump. So, is that going to be supportive to some of our industries to continue being able to export, or is that going to sound the death knell for some of those industries? So, Nico, I think that gives a little bit of a view of what's transpired in our local market. Let me leave it there, and happy to field any other questions.
Never a dull moment in markets, Ingzia. Thank you for your perspective there. I'm going to leave it at that. I see that time has unfortunately caught up with us, and as we all know, all good things eventually come to an end. We hope you enjoyed this session as much as we did, and we thank you for attending. To our panelists, Jamie, Kareem, Kingsley, we thank you for your time and your insights, and we hope we can have you back on in future. And to all of you attending, may you remain invested, well diversified, and let's hope together that the remainder of the year will be less interesting than the first half.